Hey guys, Al Lewison.
Cam McClellan.
Welcome to today's Wealth What?
Workout of the day.
So I wanted to talk today to you about the property market, and specifically in the property market, how you identify when the market is hitting the danger zone. So what that refers to is the market in most capital cities at the moment is ticking along okay. The economy is starting to improve, but at some point, everyone knows it, property does this. There's ups and downs along the way. So what I want to talk to you about is how you identify when you get into the danger zone and what steps you're going to do to avoid them.
So we got asked this week, and the reason we're doing this because we're going over an old WOD. So if you watch, when you should not invest in property, the danger zone, it explains in great detail the developer's activity chain. The reason we want to go over this again today is because we've got Deepak asked when there's a stagnant phase. It's more important to understand what El's saying, which is when's the danger zone. So I'm going to rip this out really quickly. And so this is supply and demand in about 1 minute explained.
What's this thing, Cam?
This is a market cycle. So like your market cycle clock, you have boom, correction, stagnation. You see these ones in the magazines when you go, I don't understand. You see them in the magazines or the paper or somewhere and you go, who cares what the market's doing now? I want to show people what it's doing next. So this will explain what it's doing next. So the main point that you can tell in a market is a boom. It's easy to identify when a market's cranking. It's hard to identify the other times.
So you identify it by the press is positive, property prices are moving, clearance rates are high. That's how you identify a boom.
So this is what happens. You get a boom, market clock goes around, there's a correction, and it goes around this stagnation. Now these periods usually happen, this could be 2 to 3 years, this could be 1 to 2 years, and this could be the remainder of the growth cycle.
What's a growth cycle, Tim?
7 to 10 years, thereabouts.
Let's bank on 10, be conservative.
10 at the worst case. As demand eats into supply, you get equilibrium. At this stage, the market heats up, and obviously, you get into a boom. All we want to identify is this area here. Why? After a boom, it's because developers like myself want to take advantage of that boom, and we start dumping stock onto the market really fast. So, what mum and dad investors and basic recreational investors can identify with is the easiest time is identifying when this boom's happening. When the market's cranking, newspapers have been reporting good news over a period of time, everyone's jumping into the market, is when you should stay out of the market. Warren Buffett, be fearful when others are greedy, and greedy when others are fearful.
Can I give you an example here, guys, of a city in America called Detroit? Now, Detroit in its heyday, Detroit had 2 million people in it. Detroit today has 700,000 people in it. Some industry left, to the point the government's bulldozing houses. They've got tractors in, knocking them down. Why is that? Because when there's 1.3 million people gone, there's a lot of houses sitting there that need to be soaked up by people before there's any growth in the market, any growth in the economy. So what you'll find is, they knock them down, clear it, what's happened? Equilibrium. There's enough houses for enough people, they need more houses then for population growth, and the economy starts to grow and move along. Extreme example of what Cam's saying here.
Actually, I've got to add a bit on. I love the Detroit story.
Oh, that's good, add a bit.
We study civil infrastructure that's similar to us overseas to try and get an understanding of what's occurred in different capital cities in the US and Europe and UK. In Detroit's really interesting. I've heard this for a while. So in Detroit, average house price is about $14,000. The government is saying, because they're trying to encourage people to come back and stay in Detroit, saying if you buy a house, we'll give you $25,000 as an interest-free loan, and if you stay in that house for 5 years, we'll wipe the loan off. It's a pretty reasonable deal.
Yeah.
Probably a terrible place to live, but
so for everyone watching, the suburb you live in, imagine half the population leaves, so you've got half the houses empty. Is there going to be any chance of price growth in your neighbourhood in the next century? Probably not.
So can I say, what we started out talking about is how you can identify the stagnation period. Stagnation period is really the best time to buy. I love buying the stagnation period. When the market's flat, no one's talking about property, that's when I jump in and I get my checkbook out and start going crazy. So how to identify that? I wait for a boom and I watch the market drop after that boom occurs, and once it's dropped for a year or so, my checkbook's out, I'm ripping in and I'm building my portfolio again.
Yeah, so we're pretty savage in the press. The press, and you read one newspaper, there could be 3 different articles saying different things. It's like schizophrenic. So one person's written it's good, one's written it's bad, and one's written who knows what. But I look at simple things, guys. I look at fundamentals in the market. So What's the undersupply of housing? What's the rental vacancy rate? I've got some key metrics I use to identify what's happening in the market. So I know, for example, if I'm looking at a rental vacancy rate and it's under 1%, guess what? Happy times going to get in that market, guys. There's a shortage in supply of housing. People need to live there. You sort of look at an average of 3% rental vacancy. If it's 1, get in the market. Things like that. So you need to have your metrics you're looking at, and that's something we've been big on through all of our investment journey, is understanding ourselves, not relying on others.
Beauty.